Good afternoon, everybody, and welcome to Churchill Tax Advisors' monthly Tax Investigations webinar. Great to see everybody joining us again this month. Don't forget, this will also be recorded, so if you do miss it on the live event, you'll be able to catch up on the recording, or if you enjoyed it so much, you'll be able to watch it again as well, and it's available on YouTube. If you signed up on the emails, you will receive a link to the recording, which you can watch from there. Today, I'm joined by a new colleague, Dane Skeeber, who's part of our tax investigations team here at Churchill Tax Advisors. I'll briefly let Dane say hello to you.
Hi everyone. Yeah, thanks for having me. I joined Churchill's 3 weeks ago now. I came from Grant Thornton, and before that I spent 6 or 7 years at HMRC, so training inspector.
Cool, thank you, Dane. So you've got a similar background to me. I was at Grant Thornton for a number of years as well, and I was a bit longer at HMRC. As people know, I was an investigator in the revenue for nearly 20 years, so I'm a bit longer in the tooth. But Dane's got more recent experience at HMRC, which is very useful for us here at Churchill Tax Advisors to know exactly what the revenue have been up to in recent times and how things work and their practices. Obviously, we use our experience to help clients facing investigations or making voluntary disclosures. So the experience we've got as a combined team is fantastic. Without further ado, I will start this presentation for today. We've covered the intro there. Churchill Tax Advisors provide a full tax service, tax advisory, in addition to dealing with investigations and disclosures. So please contact the team if you have any tax questions whatsoever. We work alongside accountants who need specialist advice, lawyers, IFAs, and the like, as well as obviously direct engagement with clients. So today's talk is around property taxes and the pitfalls that can sometimes befall people with property tax issues. One of the main issues, I guess, is around undeclared income and gains. If the revenue open inquiry, or you need to catch up if you've never declared rental income or a capital gain from property, for instance. We're then going to cover some of the issues around letting expenses, SLCT problems, ATED, what to do and how to comply, and private residence relief, which is something the revenue have been opening a lot of inquiries on recently. So I shall cover the point about what happens if you've not declared your rental income or capital gains. Well, we've covered some of these areas in previous webinars, particularly around the so-called nudge letters, where HMRC are sending out notes to taxpayers to check their returns. Have they declared all their income? Is everything up to date? HMRC has a wealth of information from third parties. That could include land registration, which comes from stamped documents when properties are bought and sold. Also from things like council tax, so they can see if tenants have been at a property. Obviously, if there are a number of different names at the same address, that may alert HMRC to think, is this property being let out? Have those rentals been declared? They will open an inquiry. They will also get information from letting agents. The revenue can issue a third-party notice of mass information requirements to various bodies, including letting agents, who will be required to give information to HMRC about the landlords on their books. So there are various documents and information that the revenue can obtain, and then they will cross-check that against self-assessment or partnership or company returns that have been submitted to HMRC. Have those properties been declared correctly? Has income or gains from selling the property been included on the tax returns? It's not just residential, commercial property as well. HMRC will have similar information from commercial landlords. They will either have business rates, they will have information again from land registry. They will put all that together and send maybe a nudge letter instead of opening an inquiry straight away, and that will give people time, an option to say yes, everything is actually correct, or no, I need to make a declaration. And one way of doing that is through the portal, an online portal called the Let Property campaign. There was no relaxation of the rules. There was no relaxation of the penalties. This is not an amnesty, for want of a better phrase, for Let Property. It is just a handy conduit to make declarations to HMRC. It's a good way of streamlining the process. Obviously, background work still has to be done. You still have to have the accounts in place. You still have to do tax computations. You self-assess the interest and the penalty. HMRC then review it and either agree or ask some questions. Again, we would say seek advice if you need to make such a disclosure. It can cover years right back to 2001 if there's been a failure to notify income or gains to HMRC, or if the individual or the company has taken deliberate action not to disclose to HMRC, in effect fraud. They can go back 20 years. 6 years if the revenue can only prove there's been a careless error with tax returns that have already been submitted. If the matter is more complex, if there's a large portfolio, if perhaps there's a complex web of ownership or joint ownership, etc., then Code of Practice 8 may be the way that HMRC opens an inquiry. Equally, it's possible to make voluntary disclosures under Code of Practice 8. These are the larger type of complex issues with properties that may not involve fraud or no admission of fraud. If fraud is part and parcel of the issue, either the revenue will instigate an inquiry with a suspicion of fraud, or you can make a voluntary disclosure admitting fraud, but with an immunity from prosecution. And that's Code of Practice 9, which we've covered in previous webinars as well. That's the most serious type of investigation the revenue can do, but it's handy as a tactic to self-assess as well. If you know that you should have declared the income and you've deliberately concealed it from HMRC, then you would want an immunity from prosecution. The last thing you want is the revenue prosecuting for tax evasion, which is always a possibility, even with property income. I've handled cases in the past where there's been multi-thousands, multi-millions, big portfolios of property, and for whatever reasons, things have gone awry, and the individuals or the other companies have not declared the income or gains to HMRC for all sorts of reasons. If it's been done deliberately, thinking someone can get away with it, then it's important to get that immunity. Otherwise, the revenue will prosecute, and there have been cases of the revenue prosecuting for failure to declare rental income or gains from the sale of residential or commercial properties. So they're the various opportunities and actions, procedures that can happen if, as an individual or a company or a partnership, you fail to declare the correct income or gains to HMRC. You can make a disclosure, or you may face an inquiry. Either way, we can assist and provide specialist advice. I will now hand over to Dane, who will cover some issues around the expenses of letting out or selling a property. Thank you, Dane.
Cheers, Dave. Thanks a lot. Yeah, so I'll quickly run through some of these expenses. There's obviously a wide variety of expenses that you incur in purchasing, running and disposing of a property. So we're just going to run through some of those. First off, your acquisition costs. Generally speaking, when you buy a property, you'll incur lots of professional fees, legal fees, surveys, valuations, in addition to things like stamp duty. Generally speaking, all of these costs are actually lumped in with the acquisition costs. So while you might not get a benefit in deductions and computing your profits yearly, you will get the benefit of that when you dispose of the property. Exceptions there might be when you incur some of these fees and the sale actually falls through. Unfortunately, in that situation, that's something that you'll never get any deduction for or any allowance, any relief. So the finance costs, I mean, this has been a real hot topic for the last few years now. Everyone's probably aware that if you own a property in a personal capacity, you no longer get a deduction for any mortgage interest or any finance costs linked to that. What you do get instead is a 20% tax credit. That's been phased out over the last few years, and actually from 2021, the tax credit is in full, so there's no deduction at all. If you're a basic rate taxpayer, this won't have any impact, but if you're a higher rate taxpayer, it will kind of affect your profitability and the amount of tax that you'll be due to pay. And this is why you see people moving more towards incorporating their portfolios, or if they're buying new properties, buying them through limited companies. If you wanted to incorporate a portfolio, there is something called incorporation relief that might be possible, where you defer any capital gains tax. But I would kind of advise strong planning in place for that, because there are a number of considerations that might make that either viable or completely not viable. One thing to point out with finance costs is if you were to remortgage a property, say you bought it for 500,000 and it had gone up in value to 750, and you remortgaged it and took out an extra 200,000 or so, that additional borrowing would only be allowable if it's used in the property business, if it's used to either acquire another property or whatever else. If it's just used for personal, to buy a new car or something like that, then actually that additional borrowing wouldn't be allowable anyway. Repairs is something that obviously through the ownership of a property is quite common, and the thing that you need to be thinking about with repairs is whether it's capital, whether it's an improvement to the property, or whether it's revenue in nature. If it's a like-for-like replacement, it's generally allowable, and repairs are generally like-for-like. There are some confusion sometimes. You might be replacing an avocado bathroom suite from the 1970s with a modern one. It can still be like-for-like. Only if you were replacing a bath and putting in a jacuzzi or an additional shower or things like that would it be classed as an improvement, and that's maybe where you need to apportion the cost or disallow it. Again, that would be then allowable in the disposal when you calculate your capital gains. With repairs, advancements in technology, things like that, if you were replacing single glazed windows with double glazed windows, for example, generally that would still be an allowable expense as a repair, even though it might be considered to be an improvement. So there are things there due to technological advances that would be allowable. Professional fees, legal fees, I mean, generally your management, things like that, they're allowable expenses. Your legal on acquisition isn't. But if it's as part of a remortgage or things like that, then you can get a deduction for some of those. And again, your accountancy fees would be an allowable expense. Travel costs, if you're running a property business and you have to travel to the properties to kind of maintain them or show people around or do whatever else, you do get a deduction for your travel costs. There's actually two options you can choose. You can either go for the flat rate option, which is 45 pence per mile for the first 10,000 miles, and then 25p thereafter. If you're claiming that, obviously it's essential that you keep a good calendar, a good diary, a good record and log of all of those miles that you've done. There are some clever apps out there, I think, that can kind of pick up your GPS and kind of log those for you. The second one is looking at what your actual costs are. So you would get a deduction for the actual fuel costs, wear and tear on the vehicle when you replace your tyres, when you take it for a service. However, if you use that vehicle for other things and it's not kind of wholly and exclusively for that purpose, you would need to apportion those costs. So I think it tends to be that the flat rate is the much more simplified method if you just keep a record of the miles that you've done for that business, for that purpose. And then finally on this, we've got capital allowances and replacement of domestic items. Replacement of domestic items for your standard buy-to-lets. You used to be able to get a 10% wear and tear allowance, which was phased out, I think, in 2016. That's been replaced now with this replacement of domestic items. What that is basically if you've got a bed that's broken and you wanted to replace it, you would get a deduction for that. One kind of pitfall to be aware of there: if the item that you're replacing costs you £200, and when you come to replace it, you replace it with something that costs £500, you would only be allowed that deduction for that £200. And then capital allowances, that's more on the next slide. I'll quickly cover this, but that's more that's not allowable in your kind of general buy-to-let investments, but with furnished holiday lets and commercial lets, then capital allowances is something that you could use, which is kind of akin to some of the items that you would claim for in the domestic items. Okay, so just to kind of recap some of those, really for an expense to be allowable, it has to be wholly and exclusively for the purposes of that business, and so essentially it needs to be incurred with that sole reason in mind. It can be that there may be a split in the purpose of it, and you can apportion it on a just and reasonable basis generally. And capital and revenue, that's the thing you're looking at with any kind of expenditure to the property, any physical repairs or improvements, just having that consideration. Quite often you do see people trying to claim things that would be capital in nature, and if HMRC come knocking, they quite often are successful in reducing some of those allowable expenses that have been claimed. And then just the types of property, kind of linked into that previous slide. Your standard residential is, I think everybody probably knows what that is. Furnished holiday lets are a little bit different. That's there's certain conditions that you have to meet to be classified as a furnished holiday let. The property needs to be let on a commercial basis. It needs to be furnished. It needs to be available for 210 days of the year and let out for 105 of those days. If you can kind of meet that criteria, then there are certainly tax advantages, things like the capital allowances that are available, but also the finance restriction that applies to your normal buy-to-let wouldn't be applicable. So if you owned a furnished holiday let in a sole capacity, actually you wouldn't get that tax credit. You would actually get a proper deduction for your finance costs in the same way that you would for a commercial property.
One thing, I guess, Dane, as well, is especially with furnished holiday lets, is making sure there's an adjustment for private use.
Yeah. If you use that property privately, people always assume furnished holiday lets are kind of holiday cottages, but obviously with the growth in Airbnb, people are making money by renting out rooms in that house or staying in other locations. Any of those conditions of the letting conditions for 105 days or 210 days, any private use there would kind of come out of that, so that wouldn't be allowed. And obviously if it's a room within your house, there'll be expenses that are partly attributable to that letting, but obviously you're still heating the rest of the house, for example, so you would have to kind of come up with a just and reasonable apportionment there.
Yeah, good, thank you. I will now cover some SDLT problems that we've seen and come across. There are probably historical issues, I suppose, around some SDLT. There was some SDLT tax planning schemes, for want of a better phrase, that the revenue have challenged over the years and have gone through the courts and systems. The anti-avoidance legislation has also changed. We're not going to cover any of that in detail, other than if you do have an inquiry or a problem with SDLT, then do seek advice. Do speak to us if you need help on that. One area we have seen an increasing number of revenue investigations and inquiries into is where the ownership of residential property has been by way of a limited company, and Dane's going to cover the particular issue around that to do with ATED. He'll cover that after me, talking about this particular point. But also there's an effect on SDLT. So if you buy a residential property through a company and fail to fit within the various exemptions, then there can be the higher rate charge of 15% on the property. So that only has to be over 500,000. Inevitably, this affects many people in London, South East, in particular with that type of values. Sometimes maybe somebody from overseas might not be familiar with UK tax law, tax rules, and have decided for one reason or another to set up a limited company in the UK to buy the property, and then fall foul of the rules and have an unexpected SDLT charge. Certainly speak to our tax planning advisors before buying property in the UK, if you need to make sure you do it correctly. Equally, if you're just UK resident and you need advice around buying the property, then again, make sure you take advice. This only affects if the director or connected party to the company lives in the property. It doesn't apply if you've got, so don't panic everybody, it doesn't apply if you've got a corporate portfolio of residential buy-to-lets. You will not be facing the higher charge under these rules because of that. It only affects those who fall foul of the exemptions, and the exemptions include not letting it to somebody who's connected to the company, not letting it out commercially, not developing it to resell, and those provisos affect the first 3 years of ownership. So any one time in those 3 years, if any of the particular points of exemption against the higher charge fail, then the charge will kick in. So if, for instance, the property had been owned for 2.5 years and maybe it had been empty, and then the director moves in towards the end of that 3-year period, the charge will apply. So you have to be very mindful of these time limits as well, that you don't fail on the exemptions. The 15% charge can obviously be pretty hefty liability. That was maybe unexpected or unintentional when initially buying the property through that way. Another area around SDLT, which some people may fail on or not even be aware of it, is with mixed use. There has been a number of cases that have gone through the tax tribunals about this as well. And a crucial point to bear in mind if things go wrong is to do with the facts and quality of the mixed use. So if there's going to be a commercial element to the mixed use, then that has to be real and have a strong commercial element that HMRC will accept. And the reason for applying mixed use is that you can pay lower commercial rates of SDLT rather than the higher residential rates of SDLT. So if you've got land and property, and if you're trying to make the claim that the land is of commercial use, then you can't be just growing a few herbs and potatoes on that land. It does have to be a strong commercial use. In the case there, Dr. David Hyman against the Revenue, that failed on the grounds that the land could not be proved to have sufficient commercial use in order for it to apply for the mixed use SDLT rates. So again, something to just be aware of when buying. Seek advice from our tax advisory colleagues. If you face a HMRC inquiry, again, take specialist advice and see if it's possible to mitigate the arguments HMRC are raising, which can also help mitigate penalties which could be charged. We've had substantial success with reducing and mitigating penalties that the Revenue apply on SDLT cases. And as I mentioned, a linked issue with company ownership is ATED, which Dane will explain.
Thanks, Dave. Yeah, so there's a lot of overlaps with the SDLT guidelines and what the criteria that's set for either paying a higher amount or not an ATED. ATED stands for Annual Tax on Envelope Dwellings. It was brought in almost 10 years ago now, and when it was brought in, it started at properties valued over £2 million. That's gradually reduced to £1 million and now £500,000. So the criteria is it has to be a UK residential dwelling, valued at over £500,000 and owned by a non-natural person. So that would include your corporates. Obviously, with the change to the interest relief that we talked about previously, there's a bigger drive for people to own properties in corporates. Actually, that wouldn't necessarily have an impact or a charge for ATED if it's a residential property investment portfolio that's let out commercially. But there is still an ATED filing obligation, so it's important to know that although there might not be a charge, you've still got to make sure that you file, and we'll come on to some of the penalties that might apply if you kind of fail to notify HMRC of that. The filing obligations with this one, you have to file. So, say you have to file the return in advance. So it has to be filed by the 30th of April. So for the 21-22 financial year, you have to file by the 30th of April 2021. You may dispose of that property later that year, and you would have to file another return to kind of either recoup any ATED paid if it was kind of apportioned or just to inform HMRC. Now, there's a variety of reliefs. So some of them have been mentioned in the previous slide. If you own a residential property that's let out on a commercial basis, that's fine. If you're a property developer or you carry out a development trade and you develop the property for resale, again, that's fine. There's a number of others. If you're a property trader, just buying and selling property, if you're a registered social housing provider, if it's open to the public for 28 days of the year, or at least 28 days of the year, these kind of things would mean that you wouldn't have an ATED charge, but you would still have to file an ATED return. So that's the important thing to remember, to make sure that you don't incur any penalties. If you go on to the next one, please, Dave. Yeah. So quick update on the penalties. So there's three there. Late filing. this could happen quite inadvertently. I think this is probably one of the more common ones, and you can see how it can be quite expensive. You might think, well, I don't have an ATED charge because it's let out commercially. If you don't file the return, you'll be hit with an initial penalty of £100 for failing to file a return by the 30th of April that year. If after 3 months you still haven't filed a return, it's a £10 per day up to 90 days maximum, so that's another £900. If after 6 months from the filing date you still haven't filed a return, it's either 5% of the tax due, or if you're in one of those cases where you don't have an ATED charge to pay, it's a £300 flat rate charge, and then the same charge applies after 12 months. So you can see that you've got kind of £1,600 penalty within a 12-month period for something that you might not have any tax to pay. So it's important to make sure that you get that, understand your obligations with regards to filing. Late payment penalty, it's basically always tax geared here. So if you're 30 days late with your payment, it's 5% of the tax due. 6 months late is 5% of the tax due, and 12 months is 5% of the tax due. And then in ACCUREs, it's similar to kind of the Schedule 24 in ACCUREs for a lot of the other heads of tax. It's all behavioural based, and it depends on whether it's prompted or unprompted by HMRC. So if you've established that there's an issue, or you should have filed a return and you haven't, it's always within your interest, particularly where there's tax to pay, to make that first step to HMRC. So it's an unprompted disclosure rather than HMRC coming knocking first. A couple of tips and pitfalls here. So just knowing that you've got to file in advance. It's not kind of with self-assessment, you're looking at what's happened in the previous year. Actually, with this one, you've got to do it in advance. The valuation. So the valuation, when ATED came in, it was what the property was valued at on the 1st of April 2012, and they do it in every 5-year cycles. So the next one was 1st of April 2017, and the next one will be 1st of April 2022. You may have bought a property that's worth £400,000 today when you bought it, but kind of by next April, if it's gone over that threshold, you need to have taken steps to make sure that you understand the valuation, whether it's getting something done independently or kind of having evidence to support how you've come up to a valuation yourself. HMRC will look at these properties that are kind of closely valued to the bandings, at each valuation date. So the next one will be coming up. Just making sure you're aware of that. The charge is an annual charge, but it depends on the property value as well. So for £500,000 to £1 million, and then it goes up to properties over 20 million, and the amount of the charge goes up significantly more. I think it's over £200,000 a year for the top tier ones. So making sure that if you're close to that valuation, that's where HMRC will source most of their inquiries. If you've gone onto that next valuation, you haven't returned that correctly, they will come, and then you can see the penalties for incorrect returns can kind of start to mount up. The types of property, again, it's just knowing whether your property falls within that. And the pre-return banding, that's something that HMRC offer, so you can get in touch. They have an email address. If you're unsure of what the valuation might be, or unsure whether ATED may apply, you can kind of contact HMRC in advance, and they will tell you what the valuation they give it would be, and therefore whether ATED would apply. It doesn't necessarily mean you have to agree with that, and you can kind of take your own steps, but it's a useful tool to know that you've got available to you, just to check that you're kind of in the right ballpark, or just to give you that assurance that HMRC have provided confirmation of something.
Excellent, thank you, Dane. I'm going to wrap up now with our final topic, which is private residence relief, and this is applicable to main residences only, private personal residence, your main home, where you live. The problems can happen if you've got more than one property. You have to ensure that you've nominated or elected the right one that for tax purposes, but you can't just elect on a whim. You still have to be able to prove that that particular property had been a main residence as well. The definition of main residence isn't just the length of time that you're living there, it's to do with the quality of that residence. And that's sort of a common sense rule, really. Things have developed maybe a little bit through case law at the tax tribunals, but it's very much down to, would the person on the bus, would they understand where that was your home? Is that where you live? or is it your holiday home or a second home, or is it empty, or have you been developing it and never lived there and lived somewhere else? Then you're at risk then of not being able to claim that that particular property was your main residence. And it's important to be able to prove and claim main residence because of the very big exemptions. All homes, your main residence where you live, is exempt from capital gains tax when you sell it. So that's a massive exemption. That is for now. Who knows in the future whether there will be some attacks on main residence relief due to the size of gains that some people are making on property. And equally, the revenue will challenge individuals who have maybe been doing property hopping and property moving around, sort of part-time property development or full-time development. If you've got if it's become a business of doing up properties and selling them on, you have to be very, very careful that you're actually running a trade. If the revenue can prove you are a property developer, then there is a risk the revenue will actually say this is a trade and not your main residence. Again, it's on fact and degree. If you're swapping properties very regularly and you've had a number of concurrently owned properties, you're going to be at greater risk of the revenue challenging that reliefs. Otherwise, if you fail to qualify for main residence relief, then any increase in the value of that property from purchase to sale will be a capital gain liable to 18% for basic rate taxpayers, 28% for higher rate taxpayers. There's always been a number of rumours and challenges, obviously with paying back COVID, etc. Will the revenue move the tiers for capital gains tax up to higher rate and top rate taxes? Will people potentially end up paying 40% or 45% on capital gains? It will therefore become even more crucial to ensure you've got evidence to prove main residence. And that's where sometimes these issues fall over and where a revenue inquiry may be successful. If somebody is attempted to claim main residence and they can't prove it, and there's no evidence to prove that, then obviously the revenue are going to assess it. Some people can be caught out accidentally. People move around, change their mind, something happens, they fail to keep the records, they didn't realise there's a potential capital gain on the property. The revenue catch up many years later through land registry information that they've come across, and it could be 10 years ago when you sold the property. Have you retained the documents and information for that property? Probably not, because of the length of time, and equally maybe moving home as well. You don't take everything with you. But it is vital and crucial that if you're going to make a defence that the property was your main residence, that you have as much documents and information as possible to prove that's where you were living at that time. The usual ones might be utility bills and things like that, but not everybody has time to register the utility company, or you didn't get a bill addressed to that property because it was a short period of time. Other things might be doctors, dentists, things like that, membership even of clubs, gyms. If it's your main residence, if it's linked to that address, bank statements, credit cards, if it shows that address was the registered address for loans and finance, then obviously that would help the claim. Equally, if it's with a mortgage and it was a buy-to-let mortgage and you claim it's main residence, that might be a struggle to get past HMRC and convince them that it was your main residence. It would be a go against the terms anyway with the lender, probably, for you to live there. Failing that, another crucial point is intention. So we have seen cases that have gone through the tribunal where people have lived there for quite short periods and they've still got the evidence of bills, costs, utilities, usual things that have gone to the home, but the revenue have still said, your main residence was elsewhere if you owned more than one property at the same time, for instance. but sometimes it's not unheard of someone to say buy a new property that was intended to be the new family home, but then maybe the relationship broke down, or it became not fit for purpose, or a new arrival in the family turned up and it wasn't big enough or sufficient. Then there's been a change of plan. It could be a property that was bought as a brand new one to move into, and therefore was bought from the builder originally with a deposit, but then the situation changed subsequently due to personal circumstances. That is obviously far harder to maintain an argument that it was your main residence. Not impossible, but obviously the lack of information it makes it difficult to prove your case. Ultimately, if the issue can't be settled and agreed with HMRC, then the next step is potentially going to tax tribunal or mediation ADR, which we've covered in previous webinars as well. So intention, it can be a crucial point of trying to convince HMRC of the main residence that was intended to be. Something happened. What happened? Why did it change? Talking of changes, 2020 brought in some new amendments to the rules for relief. The last period of occupation used to be an automatic 36 months of relief. Even if you'd rented the property out in between and then moved back in, you would always get 36 months at the end. It then came down to 18 months. Now it's down to 9 months maximum relief. Equally, lettings relief. So if you did let the property out at any time, but it had been your main residence at some period of ownership, you would be entitled to a maximum of £40,000 letting relief, or the lower of the main residence relief, or the gain on the property. That has now been scrapped from 2020. That was a cliff edge. If you've let the property now, you no longer get letting relief. There are one or two other complicated factors around main residence relief and employment-related work, property, for instance, or residence as well. There are other issues around that, which we're not going to go into detail here, but certainly our advice would be keep records if you've got more than one property of where you're living to prove main residence, to back up any election or nomination. If you've had more than one property at the same time, or if you've moved around, keep those records. If you don't have the records, keep a diary, keep information. Take professional advice if moving. Take professional advice if you need to make a disclosure. Take professional advice if you have an inquiry from HMRC. So today we've gone through quite a lot of areas that can be pitfalls with relation to owning property. There are lots of risks that can happen with that, which we've covered. People can make mistakes. We would say take advice before purchasing property, take advice before letting property out, take advice should you have forgotten, or in the worst case scenario, deliberately not told HMRC about rental income or gains. Then we can help mitigate penalties. We can help make disclosures on your behalf. Seek advice if the revenue come knocking, and open an investigation into any forms of property income, rentals, gains, commercial. Dane's covered ATED, SDLT issues as well around property. Penalties can be severe if you do nothing. Here's my contact details. Please email me at d.jennings@churchill-tax-advisors.co.uk, and Dane is d.skiba, S-K-I-B-A, @churchill-tax-advisors.co.uk, or give our main office a call. We'll cover briefly some questions that we've had from people who are watching this. Not had too many questions so far. Well, one just covers the last point that I raised, and that was what can you do if I have no records of me living in the property that was my main residence, but I was only there for a short period of time. As I mentioned, that is probably one of the hardest ones to defend. The more records you have, the easier it is to defend any inquiry by the revenue, no matter what it is, whether it's property or anything else. Obviously, if you've got records that support your case, your costs, your expenses, what you're doing is going to be an easier argument to attempt to convince the revenue about. If you've no records, you're not going to have that defence in your back pocket. Equally, if there's no records, then potentially there's nothing incriminating you. But the revenue will have information on documents and records, and the onus on an appellant in a tribunal, for instance, is for them to prove their case, not for the revenue to prove their suspicions. If it's penalties, the revenue have to prove the argument for penalties, and so they have to prove the behaviours that somebody has undertaken to charge a higher penalty, but otherwise you as an individual or in a company have to prove your case to the revenue. So if there's no records, it is going to come down to hearsay. It is going to come down to intent. It is going to come down to what you know. Ultimately, therefore, if the case proceeds to a tribunal, it will be on the grounds of, are you a credible witness? And cases have been won at the tribunal on credible witnesses who've been able to show and prove sufficiently to the judge that they were living in that property during that period of time and that it was their main residence at that period. And that has been sufficient. Obviously, it can be a hurdle to get over. It's a difficult one to maybe convince, but it will rest on how credible you might be as a witness in giving that information and facts and background of your personal circumstances and why records have not been maintained or were not obtained at that time. So yes, good question, but not a simple answer. I think questions of I think we must have flummoxed everybody on the properties today. We've blinded them with science, Dane, or people are a bit shy at coming forward with their questions today. Obviously, if you've got questions about property, then please do give us a call. Please contact us, drop us an email. Either us and the team will help you. If you need proactive tax advice, then again, Churchill Tax Advisors can help you with your property portfolios and investments and tax issues. Thank you. We're running short of time now. Thank you very much for joining us or for watching this video, everybody. We will be back in a month's time on another topic relating to tax investigations and inquiries. In 2 weeks' time, our colleagues will be providing their webinar on a interesting tax advisory point. So please join them. Otherwise, we'll see you next month. Thank you, everybody. Goodbye.
Thanks, everyone. Cheers. Bye.